Good afternoon, everybody. Appreciate your time today. This is Dan Strecker at Walker Jackson. And Liz and I were talking the other day and had kind of an interesting topic. I'd read several articles, and I couldn't tell whether these articles were trying to be truthful or a little facetious, because they focused around the point of how difficult it was for folks to buy a home these days, and essentially that you more or less had to have perfect credit and 20% down payment. And I read 2 or 3 articles like this, and I started to think, I think people actually are starting to believe this. And so Liz thought, maybe it'd be a good idea if I did a little webinar and got some information out there. Some of this may be redundant to you. Hopefully there's some points you take away, but there are a tremendous amount of opportunities out there to get a home without what I would call perfect credit and without a whole lot of money down. So that's what we're going to go through, and I'll try to be fairly brief and then open up to questions, and hopefully we'll learn a few things today. So one of the first programs that I'm going to talk about is relatively new to us and kind of a hot topic out there, and it's called Homepath. And Homepath is a special financing option for Fannie Mae foreclosed properties. And so Fannie Mae has said, we own these properties in these neighborhoods. We want to get them back out there. We want to incent people to take basically the property off of our hands. And so it's an incredible program, to be quite honest. It's a 97% loan to value for an owner-occupied. You can do second homes and investment as well at 90% and 85% for investment. The thing that I love about it, no mortgage insurance, which is, from those of you who are familiar with FHA, it's become a very big monthly premium. Other thing I love about it, no appraisal. And anytime we can do a deal without an appraisal, that cuts a lot of work out of the deal, a lot of questions. So it is fantastic. You would think at that you need a stellar credit score. 660 will go up to 97%. I know that's a little higher than some FHA loans, but that is still a very relatively low score in today's world. It can be as low as 620 for some lower loan to values on the owner-occupied side. Debt to income is a little bit more restricted than some at 45%, but again, remember, you don't have any monthly mortgage insurance to drive that debt to income. There are some exceptions that we could get up to 50%. That is really determined by the strength of the client. So the more compensating factors that we could drum up, the chance would be there to get something a little bit higher. And so the other thing I think is relatively special, if you are familiar with the changes in the market, you can do condos. Condos are something that are extremely difficult to get done these days. So if it is a Fannie Mae owned property, you can do it as a condo. Now the restriction to this is obviously it has to be one of their properties. So I put the website on there, homepath.com, to locate the properties in your area. And what I encourage you to do is to take a peek there, keep going back to that site. My thoughts on some of these programs is, and if you were at the Platinum Group Services, they told you some of these statistics. There is such a large number of properties that these government entities and banks are holding on their books because they're afraid to deliver them all to the market at one time and really impact values, that to me the opportunity for this type of a product, and the next one I'm going to talk about, this could be something that we're able to use for months or if not years down the road. So I don't think this is just a quick jump into the market and get out with this program. So the interesting thing about this is, you look at it right away and you see some similarities to an FHA loan. Well, if you have a product that is Homepath eligible, I did a spreadsheet, and each of the loan officers has this, that would compare what a Homepath loan would look against an FHA loan for that property. And it is by far better to do the Homepath because of the no mortgage insurance, even if the rate is higher, and it will be higher, because you don't have that large mortgage insurance, no appraisal, no condo cert if it's a condo. It is much more beneficial to go this route. So if you're not familiar with this product, I'd encourage you to talk to a loan officer in your office or on our sheet, or myself, to learn a little bit more about it. It's pretty fantastic. Another one that we deal with and hopefully you know about is the HUD $100 down program. And so this is HUD's version of how they want to get rid of some of the excess inventory on their books, and they take their normal 3.5% down payment and said, we're going to do it for just a $100 down payment. It is has to be designated as such, so they don't necessarily do it on every HUD-owned property, but I've heard recently that they are trying to expand it to every HUD-owned property. It's owner-occupied only with a $100 down payment, 640 credit score. The debt to income is whatever our findings show, so it could go as high as 55%. Occasionally we've seen even a little higher than that, but that's, you're really kind of pushing the envelope. But whatever our approval, automated approval gives us is the debt to income that we can go with. A couple interesting features. You can do repair escrows on this. Our operations team is able to do it on this product, and it's pretty unique in how this program goes about things. The appraisal is done up front by HUD and their intermediary company, and the inspection is done. So we don't do a new appraisal or new inspection here. This is almost kind of the CarMax version of buying a house. The negotiation is in large part done, but this gives the buyer an ability to see these items and see what issues there are. And you know, because HUD has done the inspection and the appraiser, they're saying that we're going to insure this property as is, but they also provide some money for things that they deem need to be fixed, you know, for livability for the client. So those are all worked out. We get contractor estimates, and we can escrow those in. There's a little bit more to it, but you know, a short story is that we can escrow some of those repairs. And then as long as our loan to value, including the upfront mortgage insurance, does not exceed 100% of the appraised value, we can finance in the mortgage insurance. So I've never had it where it didn't. So it's a relatively safe bet. So I've attached the website there to look at some HUD-owned properties with your clients, if that's appealing. So those first two are some pretty neat opportunities to take that home buyer that doesn't have a lot of money down and maybe has some other issues that we want to try to get around. So, for example, we're doing a Homepath right now that's a condo that just would not meet normal investment requirements because of the investor concentrations and some legal issues, but no appraisal, no condo cert fits into that Homepath product. So those are the first two that I don't think get a lot of attention. That could be some really nice opportunities out there for folks. Next one, a little bit more familiar. It's the USDA rural housing. So if you have not done this, this is a fantastic product. We do a lot of these. When this first came out, I probably read the guidelines 4 times because I thought that I was missing the catch, that there was something there. There had to be a catch to this. And then I thought, well, I got it. It's specific geographic areas, and there can't be any of those in our Tri-County area down here. And then, you know, I was shocked. And I have the website at the end of this that I'll show you. There are more rural housing properties out there than you realize, and in areas that you would not think would be labeled rural. So don't discount this as a legitimate opportunity when you're out there trying to help folks that don't have a lot of money down, because these properties are out there in neighborhoods that you would not think would be labeled rural. So it's 100% loan to value, owner occupied. Again, another fantastic opportunity. No monthly mortgage insurance. So anytime we get those products, we love them. You have an actual potential to finance in the closing costs up to 100% of the appraised value. So this almost makes it a purchase that acts like a refinance. So it's a tremendous opportunity right there. In addition, there are some occasions where you could potentially finance in approved repairs at the closing. So if there were some items that through the negotiations in USDA felt that they were repairs that needed to be done, and we had a contractor that was going to do them for that price, and the contractor is willing to be paid at close, you know, it's potential that we could finance those in so they're not out of the client's pocket. So again, pretty impressive. Now there are some income and property restrictions to this. So again, you would have to search the site to find out if the property itself was eligible for rural housing. And then, there are income restrictions on the high end. You have to qualify for the loan with normal debt to income, but you can't make too much basically to afford this. And off the top of my head, I don't recall exactly what those are, but they're pretty aggressive numbers. It's not as low as, say, a state housing. I think for an individual, it might be in the $75,000 annual income range. Don't hold me to that. Your loan officers are going to know that better than I would. But again, if you're not familiar with rural housing, fantastic opportunity for clients. The next two are the most common ones that we know about and utilize. It's your standard FHA and your VA, 96.5% and 100% loan to value respectively. FHA does have the upfront mortgage insurance premium and a 1.15% monthly mortgage insurance premium. That's a recent change within the last several months. That monthly figure has gone up and really made FHA slightly less attractive because it's a pretty big monthly premium there. So that's why we're, all things being equal, if it fits into one of the other ones, that may work out to be the best opportunity for a client. And VA obviously has no monthly mortgage insurance. Some people get confused about this. Condominiums are eligible for both products. Now, it's not quite just as easy as that. VA has a site of their approved projects, so it has to be on that site of approved projects and would have to meet, the normal condo criteria. So you can't have pending lawsuits, you can't have excessive delinquencies on homeowner dues, excessive investor concentration. And FHA went through a change, it might even be as long as a year now, where they don't do what's called a spot condo approval, which means that they would improve a deal by deal. They don't do that anymore, period. And they have two types of approvals. They have what's called an HRAP, which is their approval, and a DELRAP, which is a lender approval. So anything that is an HRAP or approved by HUD, we can do as long as their approval is not expired and that it meets their requirements of owner-occupied concentration and FHA concentration. But there still are possibilities to do condos on FHA and VA. So the smart thing to do there is to, again, get with me, get with the loan officer ahead of time to find out if that project is eligible. And we can find that out relatively quickly for you, and could even show you where to find that on the site as well. Of course, gift funds are acceptable as a form of down payment on FHA, which is helpful. Potentially makes that a zero out of pocket for a client. And most recently, there was a loosening up of our guideline where our conventional went from 95 to 97% loan to value. So now this conventional doesn't really cater to the lower credit score borrower, so that 97% does come with a 720 credit score. So, a little bit more higher end profile that you're going to have there, and you do have the mortgage insurance. We'd have to do the math there to see which pans out better between an FHA or a conventional loan when you get the rate involved and the mortgage insurance involved. But again, it's another opportunity, so it's exciting that we added at least 2% there. So I know I went through that relatively quickly, but I didn't want to make this a guideline call. I just wanted to put out there some information that there's a good 5 products that actually cater to the low down payment clientele. So again, your loan officers are pretty educated on all these things. They do have that spreadsheet that would compare Homepath to FHA, or even an investor deal. I compared Homepath to conventional, and Homepath was a better, even at a higher rate. So they can help you with any questions you have. And I thought right now, I'll if Liz has questions, I'll repeat the question and then answer.
John Collins says, do USDA properties have to be offered as such, or does just being in an eligible area make a property a candidate?
Right, so good question. It was, does USDA property has to be offered as such, or I think what it means is labeled that it's a special financing deal, or is it just anything designated in the area? So it's solely based upon geography. If it is in a USDA rural housing labeled area, and that website will tell you whether it's in there or not, then it fits USDA financing. The only ones that have to have a special financing label to them would be Homepath, and the HUD $100 down have to designate that they're eligible for that particular financing. And on the homepath.com site, all of those properties are. So good question. Okay. Yes, any other questions out there? I know it's relatively basic, and some of it may be pretty repetitive, but we've gotten a lot of folks that just haven't heard about some of these products or have some misconceptions maybe about the benefits of it or how it could fit in with a client's needs. So, all right, that either means I picked a really boring topic or it was an incredibly efficient presentation. So when I walk out here, I'll have my own opinion. So, but I appreciate you all attending. I know it's very busy, especially at the end of the month. Liz, were you going to do